3 ways to optimize your 529 plan contributions. If you're a parent or grandparent, chances are you've thought about helping your kids or grandkids with college, and maybe you've heard of a 529 plan. But here's what most people don't realize: it's not just a savings account. With the right strategy, a 529 can simultaneously help you reduce taxes and support future generations while efficiently passing on your wealth. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. So, what is a 529 plan? Well, let's start with the basics. A 529 is a tax advantaged investment account designed for education. You contribute after tax dollars, it grows tax free, and if money is used for qualified education expenses like tuition, books, rooms, and board, you don't have to pay tax on the capital gains. In a way, it's like a Roth IRA, but for college. Beyond saving for college, 529s can also be a powerful tool for tax efficiency, gifting, and estate planning. For instance, in many states, you may get a state income tax deduction or credit for your contributions. And the compounded return that comes from reinvesting these savings can have a huge impact on your account balance over time. So here are 3 ways you can maximize your 529 contributions. First, if you have the means, you can do what's called a 5-year election, also known as superfunding. How it works is that the IRS lets you contribute up to 5 years worth of annual gifts all at once. That's up to $95,000 per child per person based on 2025 regulations. The contributions are spread evenly over 5 years. So let's say you contribute $50,000 to your child's 529 plan. That will be applied as $10,000 annually for a 5-year period, which would leave you with $9,000 remaining in annual gift tax exclusions, all without impacting your lifetime limit. Now, how does this help? Well, the earlier you contribute to a 529 plan, the more time your money has to potentially grow, and it lets you shift assets out of your taxable estate. However, it's important to remember that superfunding is only possible when contributions in that year exceed $19,000. You also need to take into account any other gifts you make to the beneficiary during that 5-year period to make sure you don't go over the annual exemption limit times 5. Second, choosing the right plan. You can open a 529 plan in any state, not just the one you live in. Some states offer strong tax benefits and low cost investment options, while others may charge higher fees or offer no tax incentive at all. The impact of fees compared to credits compounded over years can mean several $1,000s over time, so weighing different plans is key. A couple good examples would be the California plan or the Virginia plan, both offering good quantity of investment options at reasonable fees. Third, adjusting your risk over time. One of the best ways to get the most out of your 529 is to treat it like any long term investment. That means taking appropriate risk early on. For example, for a newborn, you've got 18 years until they go to school, so a more equity heavy allocation is usually appropriate to maximize long term growth. However, as they get closer and closer to college, you might want to shift into a more conservative allocation to protect what you've already built. Now let's talk about what to do with unused funds in a 529. What if your kid gets a scholarship or they decide not to go to college? A common concern we see with our clients is the fear of overfunding accounts. And what we tell them is that that money won't technically be wasted, even if it's not used. There are several ways you can make the most out of unused funds. First, you can change the beneficiary at any time to another qualifying family member. That includes siblings, cousins, nieces, nephews, or even yourself if you want to take a couple fun classes. Second, a new 2024 rule allows you to roll over unused 529 plan funds to a Roth IRA in the name of the beneficiary, all tax and penalty free. However, there are certain limits to account for. The 529 has to have been open for at least 15 years before that conversion. The lifetime rollover limit is $35,000 per beneficiary, and transfers must be within the annual contribution limit, which in 2025 was only $7,000. And no contributions or capital gains from the last 5 years can be transferred. Finally, funds can be used for apprenticeships, vocational programs, and even private education K through 12 tuition, as well as student loans up to $10,000. Overall, 529 plans aren't just a way to save for college. They're a strategic tool that, when used intentionally, can grow your wealth, reduce your tax burden, and support your family's future for generations to come. I'm Justin Kuntz, Managing Director at Pacific Wealth Management. And if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com. Thanks.